And the markets do all of nothing yet again. It is as though we have settled into some sort of lull in the wake of last week's fireworks when we got that U.S. jobs data and a generally market friendly tone from the Federal Reserve. The markets now unable to follow through. But that doesn't mean that there's nothing to do in these markets. And in fact, stocks are not the only game in town, as it looks like we're getting a little bit more action in currencies. The US dollar has been quietly returning back on offense. And what we find here is a set of monetary policy announcements from central banks not named the Federal Reserve that are really in the driver's seat there. We spoke at the beginning of the week here about the Australian dollar and how that was vulnerable to a dovish RBA. We now turn to the Bank of England. This is, of course, Macro Money. I'm Ilya Spivak, head of Global Macro here at tastylive. And what we're going to do here is break down how the US dollar might be positioned to advance against the pound here as the Bank of England delivers its monetary policy announcement. This is going to be one of those big quarterly affairs where they update their forecasts, they update their guidance, and there's a whole lot to chew on here that may ultimately leave the markets with the sense that despite whatever we're thinking about the Fed this way or that, it is likely to out-hawk its major counterparts. So let's begin here, first and foremost, with the way that things have evolved in recent months. And what we see here is in the green, the outlook for Fed monetary policy as it is priced into Fed funds futures. In the light blue, the outlook for ECB monetary policy as it reflects in ESTR futures. In the dark blue, same thing for the Bank of England in SONIA futures. All of these are essentially interest rate futures, and in them is implied a path of interest rates. And what we see here is that since about, let's call it late October, early November, you can see it right here, the outlook for the Fed starts growing more dovish. And we, of course, know already the consequences of what this meant for stock markets. They obviously surged in the fourth quarter. They continued to surge in the first quarter, even as economic data that was hotter than expected started to push up the outlook and take out some of the rate cuts that were there in the outlook at the beginning of the year. So when we kicked off 2024, the market was seeing the Fed cutting maybe 5-6 times. Over the course of the first quarter into now, we're looking at 36 basis points being baked in, which essentially amounts to 125 basis point cut and about a 44% chance of a second one. What's interesting here is that we can see the pathway for the ECB and the Bank of England has followed in tandem. And that's because when the Fed changes rates or the outlook on Fed policy evolves and rate markets move to reflect the repricing, that echoes everywhere. And the reason is because almost all global monetary transactions are settled in terms of US dollars. I brought back this chart here. This is data from the Bank of International Settlements from their latest survey of FX markets from 2022. And what you see here is just how overwhelmingly dominant the US dollar is in global markets. I've highlighted the BRICS group as a group in red down here, just so we can once again see how laughable these recent headlines about the BRICS wanting to challenge the dollar's supremacy sound. I mean, this is high comedy. There is no way, no how that we can even begin to talk about these economies even starting to challenge what's going on and the kind of volumes that move in and out of the dollar. And the reason that this is so impactful for other economies, then, of course, is when the markets begin to expect that the Fed is going to have fewer cuts, that drives up yields in the treasuries market. But of course, that then also drives up yields everywhere, because what it does is increase the cost of borrowing dollars. And given how ubiquitous dollars are in global commerce, it drives up the cost of borrowing in general, everywhere. And so what we see here is that in sympathy with the adjustment made for the Fed, the number of cuts for the Bank of England and for the ECB has significantly fallen away. But the economic underpinnings, the actual policy calculus faced by these central banks, is vastly different. And so what this creates is an opportunity to see renewed divergence, and for FX markets to reflect that renewed divergence with price moves that are tradable. So we saw this earlier in the week in spades with the RBA. Markets had fully erased all rate cuts from the RBA outlook since the beginning of the year up through this week. And then the Bank of the local central bank, the Reserve Bank of Australia, came out and said, actually, we're more like neutral, and we see all these potential reasons why we need to be concerned. And the markets went, right, we overshot, and the Australian dollar fell. If we look at the situation now shaping up for the Bank of England, consider in the US, inflation has in fact stopped falling. It's not rising, but the process by which it has been declining here has been clearly arrested in recent months, whether you look at CPI or you look at the Fed favored PCE gauge. We've gotten stuck here. And the reason is because inflation in the labor market seems to be baked in and not quick to leave, while there is still about a 2.2 million worker deficit in the labor market. So while inflation, whether you look at CPI or PCE, has fallen by more than half, the employment cost index has fallen by less than 1% as of the first quarter. So we're looking at a situation here, as of the second quarter, excuse me. What we're looking at here then is a situation where there is, at this point, a very different story in the US than in the UK, for example, and this is just as true of the Euro area, but it's the ECB that's on tap today. Disinflation continues. In fact, at 3.2% on CPI, which is the latest reading that we're looking at here, we have the slowest inflation since September of 2021. Much more importantly than even just the direction and the level is the makeup. So consider there was a big upswell in energy and, by extension, transport costs from 2022 onward. And of course, that makes sense. This is the beginning of Russia's war in Ukraine. And there was a big scare around what that would do to disrupt energy supplies to Europe at the onset. And so there was a big upswell in this housing, utilities, and fuels category. And that's a rise in fuel cost. By extension, there's a rise in transport cost that follows on. And we can see that has dwindled at this point and is actually, across both categories, a deflationary force. It is actually shaving inflation down. Then last year, the main story was food inflation. We can see that upswell here. That was an outsized contributor. That has fallen off. So what we've seen is a sort of spreading and a broadening of disinflation. And what you're left with, these two categories right here, are discretionary spending. First, recreation. Second, restaurants and hotels, hospitality. And you can see that here. This is a little bit of a cleaner way of looking at the breakdown of contributions from the March CPI report. You can see here food at this point contributing less than half of a percentage point to overall inflation, having been easily the dominant force last year. Here's fuels. They're actually shaving about a quarter off inflation. The transport side of things is basically flat. Here are the two big standouts: recreation, hospitality. Now, when it comes to food, it is likely to continue to be a source of cooling inflation going forward, because as we can see here, for those economies where this was a major source of price growth, Eurozone, UK, Japan, they tend to lag global food prices in CPI by about 7 months. In the green here is the World Food Price Index from the United Nations FAO agency. And so what you find here is if you lag these CPI numbers 7 months, that's where they find lining up with this index. And you can see that there's about 7 months more of tail here for food prices to continue falling. There's something of a little twitch right here since the beginning of the year where things are getting stabilized. So let's call it maybe not 7, let's call it 3 months, 4 months of lingering disinflation that's in the pipeline here on the food side of things. So that's likely to continue to get better. But what about these things? Recreation, hospitality. Well, because these are discretionary spending categories, they seem likely to be amenable to slowing economic growth. And boy, do we have anemic growth conditions in the UK. So for the past 2 quarters for which we have data, which is the fourth and third quarters of last year, the economy actually shrank. And so we had a recession. The expectation is that we're going to return to positive growth in the first quarter, and indeed, the PMI data has shown a little bit more of a perking up recently. But lots of good that does when we look all the way back to the beginning of 2022, and since the second quarter, the range of growth has been so anemic that at no point has the economy grown more than 0.2% in a quarter, and at no point has it really built any kind of momentum, even modestly. This is completely listless. The expectation is that we're going to grow 0.3 or 0.4% in the first quarter, but as we know, that won't even begin to make back what was lost here. You need to grow in excess of what was lost, even to get back to break even on the size of output. So, and that's just arithmetic. So the economy is in a weak state and ostensibly could use some cuts. That's exactly the kind of thing that would work against these kinds of holdouts. A weak economy is something that doesn't bode well for discretionary spending categories. People are likely to trade down into essentials against the backdrop of weak economic performance. So what we have here currently, after this adjustment since the beginning of the year is 55 basis points in cuts. So that's a total of 2 cuts that are baked in at 25 basis points apiece before the end of the year, and a very slight chance that you're going to get a third one. So about 5 basis points out of a 25 basis point cut baked in there. So a 20% chance that we're going to get that third cut. Now, to the extent that this adjustment has been in sympathy with what's been going on with US rates because of the dollar's kind of gorilla in the room influence on global markets when it comes to the cost of credit, we have a situation where if the Bank of England is going to paint us a very different narrative, then the direction of this adjustment doesn't really make sense. And although the level change is still giving us many more cuts, at least one more cut in the UK, already baked in than in the US, so credit spreads are already favoring that much, the spread may widen. Now, from the Bank of England, we are going to get a deluge of information. We're going to get the policy announcement itself. We're going to get minutes from the meeting of the MPC, which is the UK Monetary Policy Setting Committee within the Bank of England. 9 members on it. They vote, 1 member, 1 vote, including Governor Andrew Bailey. The way that they've been voting recently, 8 members have been voting for stasis, 1 has been voting to cut. So we'll see how that tally evolves. If even one of them moves into the cut camp and we start having a 7-2 vote, that would already signal that we're kind of moving in a more dovish direction and rate cuts are becoming more immediate. So we'll get the policy announcement. We'll get the minutes from the MPC meeting and the vote tally. We're also going to get the quarterly monetary policy report where the Bank of England is going to tell us where they see things going over the next 3 months, what the lens is through which they're looking at. That's going to update expectations on growth, on inflation, on the path of rates. Very similar to what we're going to get from the Fed when they update the broader set of guidance in June. So whole lot to chew on here. And then on top, we're going to get a press conference with Governor Bailey where he's going to attempt to explain all of it. So tons of inputs. As it stands, the 2 cuts break down something like this. We're at 5.25 now. By August, it looks like we have the first cut. By December, we have the second cut. There is slight optionality on the cut appearing a little bit earlier in June, but that's about a 50-50 shot. Slight optionality on the second cut appearing in November. That's about a toss-up. But we can clearly see that since the beginning of the year through now, there has been a hawkish shift. So there's still cuts, but the path has become shallower. At the start of the year, when the BOE met in February, we were looking at a full 100 basis points in cuts, essentially, from 5.25 to 4.25 here. So as we get all of these inputs, the really critical question will be, does this shift actually make sense? And do the makings of inflation in the UK and the growth dynamics, more pronounced disinflation in terms of the path, and obviously inflation is still higher in the UK than it is in the US. I mean, again, take a look here. We're at 3.2%. And if we look every which way at the US, CPI is, we'll say, about in line, but the Fed's target, the PCE, is lower. But it's the direction that matters. Here, stasis for a few months now. In the UK, disinflation keeps going. The growth dynamics are very different. The U.S. has cooled somewhat recently, but it is certainly doing much better than all of this. We just got a GDP report with an annualized growth rate of 1.6%, and everyone was disappointed because it wasn't over the 2% or closer to the 2.4% annualized rate that markets were looking for. So as we consider this, and of course, these are quarterly numbers, those are annualized numbers, but the upshot remains the same. We are looking at a situation here where the US is growing faster and is at the same time seeing inflation stickier. Whereas in the UK, it's very much not that. So with that in mind, the Bank of England might well say, you know what, yes, we've had this adjustment that's happened in sympathy with what's occurred in the US, but for us, it actually makes sense to be even more dovish than the slight edge that US dollar rates have here. We might move faster, and it might be 3 cuts, not 2, that the markets ultimately surmise after this meeting. And that makes for an interesting setup when we look at the British pound. It has been meaningfully soggier than some of the other currencies against the US dollar. Obviously, last week, the dollar took a little bit of a knockback around the weaker US jobs data and the more dovish kind of version of events from the Fed. And so the dollar had its moment of weakness. In fact, you can see on Friday here, the pound spiked with that jobs data and even attempted to break the 126 level and then failed in dramatic fashion, retreated right back into this congestion range. So we're kind of flirting with a break of support here, seemingly. Not quite there on a daily closing basis, but on intraday charts, we're starting to kind of push through 125 here as a kind of line in the sand. If we get a dovish Bank of England, we may well make a concerted move on the downside. Now, this can be a short that is taken ahead of the meeting. I've been short for a bit, so I'm not really looking to add to it immediately into the policy announcement. But the more aggressive version of this will be to sell into the announcement. The less aggressive version, if you don't already have exposure, is to let the market come to you. If there is something dovish that demands repricing here, then we get a move lower into this support and perhaps some jostling and bouncing around it, which with confirmation could give an entry point first closer to this level on a bounce to sell into a move back under 124 into this support. But ultimately, if the sell-off is in fact about reconfiguring policy expectations, it's going to have legs for at least a while. And so ostensibly, any down move that then takes this out could have some serious extension lower, and that's an incorrect price label. Ignore that, obviously. That says a little bit, that's a little bit less aligned. But the important thing here is that it is, of course, under 121. And that's exactly right. So we're looking at a move, perhaps, if we clear this, of as many as 400 pips in open space on the downside. So quite a bit of a trade if this really opens up. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show that I co-host with Chris Vecchio and Dylan Radigan, looking at the Wall Street close and where things might be heading thereafter. Every Wednesday, as today, I am on with Victor Jones for The Price of Truth. That's coming up with just about a 30-minute break after we get done here. I'm back on with Chris for Futures Power Hour on Fridays, and back on with Victor and Tom for First Call on Sundays. I'm also writing for the news and insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very, very much for joining. See you soon.